Hello everyone, welcome to the healthcare-focused VC investment trends in 2023. First, let me introduce myself. I'm Ramesh, Dontha. And so my 1-minute introduction is I'm a serial entrepreneur, I'm an angel investor, and so they're not like venture capitals. So they have these big bags, okay, so of money. I'm an author and a podcast host. So that's my quick introduction. And if you want to check me, so go to LinkedIn, send me a connection, and there's not a single connection that I've rejected so far. So pretty much I'm going to accept anything that you're going to send my way. So with that, so the discussion is going to be about them. And by the way, the more audience participation, the better. And there are surprising gifts for the audience participation. And we have not announced this, but I think the best question gets some funding. Okay. So with that, let me introduce Neil. Neil Littman, if you could introduce yourself, and we'll go one by one.
Sure. Hi, everyone. Thanks for having me. This is a really great opportunity. So my name is Neil Littman. I'm the founder and CEO of Bioverge. Bioverge is an investment platform that I founded about 6 years ago with a mission to democratize access to enable more individual investors to invest in the VC asset class, and in particular in healthcare startups. Maybe I could just share a little story with you that serves as the inspiration for what we're doing today. So it was about 8 years ago when I quite literally saw science fiction come to life. I saw a little girl by the name of Evie cured of a previously incurable genetic disease. At that time, I was working at the California Institute for Regenerative Medicine, which had a $3 billion fund and invested in over 50 clinical trials in the regenerative medicine space, and Evie was a participant in one of those trials and was cured of SCID, or severe combined immunodeficiency. And it was such an amazing and impactful experience that I said, wow, why can't more individuals invest in these kind of companies, these types of technologies? We had a couple of big wins at CERM. We had one company that we invested in that went public at a $1.2 billion valuation. Another was acquired for over $300 million. Another was acquired for $4.9 billion. So I said, wow, as an individual, I really want access to invest in these types of impactful companies to try to generate outsized financial returns. And there was really no way for me as an individual investor to do so. So I really initially built Bioverge to solve my own problem. Fast forward to today, we have a network of over 3,000 accredited investors that invest with us in our deals. We have a portfolio of 34 companies. We have a new partnership with CharmHealth around a digital transformation fund where we're specifically focused on investing in digital health and digital therapeutics products. So we do a number of things, and we're really catering to individuals to try to democratize access to the asset class.
Thank you, Neil. And Raj Sabhlok. And before I introduce Raj, so I just found out yesterday, but checking LinkedIn, that Raj and I went to the same business school. So, all right, so Raj, he will introduce himself. He will let you know which school he went to.
Well, and hopefully nobody holds that against us, right? We went to Duke University School of Business. So, as Ramesh said, I'm Raj Sabhlok. I'm kind of on the opposite side of the table that I'm normally accustomed to. I've typically been associated with operational roles at tech companies, software companies. The last kind of decade and a half have been with companies that are in the SaaS business, which, by the way, I see a lot of parallels to SaaS and healthcare and health tech, if you will. And so I find that to be pretty interesting, and it's an easy way for me to kind of draw those connections between SaaS businesses and healthcare and health tech. I'm currently with BVP. Like I said, I'm on the other side of the table these days, and BVP is Bessemer Venture Partners, a very large tech venture capital firm, and something like 10 billion plus in the various funds. And healthcare is one of the focus areas. We call them roadmaps within the firm, where we have dedicated folks that are building out these roadmaps and then trying to execute with making investments in companies that fit our thesis. Personally, as I mentioned mentioned, my specialty, my focus area is SaaS. But I do see, as I said, some overlap with healthcare, and so naturally, by extension, I've got some interest in those areas as well.
All right, so now let me give the mic to Bryce Sonsteng. So if you could introduce yourself, please.
Okay, yeah, and thanks for having me. I'm Bryce with Tri-Valley Ventures. Tri-Valley Ventures is an early stage, regionally focused fund on the 5 cities here: Pleasanton, San Ramon, Livermore, Danville, Dublin. So if you're in the city, it's where the food is grown. And we manage about $40 million between 2 funds. And the sort of thesis behind Tri-Valley Ventures is that in this area, you have a ton of technical and executive talent of folks who lived and operated in Silicon Valley for a long time. And when it was time to start their family, they moved out here for the quality schools, better cost of living, higher quality of living. And when it came time for them to start maybe their second or third company, they started it here. And so we found it very interesting that there wasn't any sort of dedicated capital source here, and that's why we set up Tri-Valley Ventures. So I believe it was in 2014 or 2015, MIT did a study on the best places in America to start a business. And they identified that Tri-Valley is top 1%. And the criteria that they used was the quality of research institutions within close proximity. And we don't have a college or a university like Stanford or Berkeley, but what we do have is 3 national labs within 25 miles. It's actually the only place in the world that has 3 national labs within 25 miles. Lawrence Livermore, Sandia, and Berkeley. So our focus for Fund 1 was kind of generalist, and then we really identified 3 different verticals that are just a result of kind of the history of the region: enterprise software, life sciences, which is our flavor of healthcare, and deep tech. So specifically, I actually, in preparation for this, did a little bit of history on why life sciences and diagnostics is so such a large ecosystem in this small populated area, relatively populated area. And it all started with, about, as far as I'm concerned, in 1976, a company called Vertec, which was a diagnostics device to identify congestive heart failure, which was sold many years later for $3 billion to St. Jude's. There was Roche Molecular had acquired part of Genentech, I think actually all of Genentech, and Roche Molecular is here. That's sort of set the stage for Thermo Fisher, Carl Zeiss, who has all have presence here, 10x Genomics, of course. So we're investing in it's probably about 50% of our portfolio, and I would say that healthcare obviously is a very broad term or broad industry. So whether it be health tech, biopharma, or life science devices, about 50% of the healthcare companies here are life science devices companies. So that tends to be more of what we have in our portfolio.
Excellent. Thank you all and welcome. So with that, the structure of the discussion for the next 30 minutes or so is going to be from 2 sections. So one broad section is from a VC to the founders, like what's the, how is the landscape changing and all that stuff. That's one area. The section 2 is more about from a founder's perspective, like how should they adjust, what's the advice we get from the VC. So that is the general the outline, but we switch back and forth. Again, if you have a question, please raise your hand. We will not wait until the end to take your questions. I would like to weave in your questions through the discussions. So with that, Neil, first question to you. I mean, by the way, these questions all of you will answer. So there's elephant in the room. It came yesterday and today as well. The landscape is changing. Interest rates are going up, right? So there is a talk of an impending recession. So what does it mean from funds coming into the VC land, right? So 2021 was an outlier. 2022 definitely is significantly reduced from $30 billion to whatever that is. So what should, how is the landscape changing from funds coming into the VC land and going into 2023, please?
Yeah, so as we all know, it's changed dramatically. And I think the wake-up call for all of us is, at some level, we all are macro investors, right? The macro climate has a big impact on capital flowing to higher risk asset classes like venture capital, like biotech. So just a couple quick stats for you. So through Q3 of this year, the digital health ecosystem, there's been about $12.6 billion that have been put to work. Through all of last year, that number was about $26 billion or so. So we're going to be dramatically lower through the end of this year than we were last year. Not a big surprise there, but pretty big impact. In the biopharmaceutical sector, we're going to put about, I think, $23 billion to work through the third quarter of this year. Compare that to about $33 billion from last year. So again, a pretty big reduction from 2021 levels to 2022 levels across the board. Digital health has been impacted more than biopharma, for sure, but as we all know, biotech, biopharma is much more capital intensive, so there continues to be some investment in that space. So I think what we're typically seeing is, besides a sort of a risk-off trade, that a lot of venture capital funds are reserving more capital for supporting their existing portfolio companies. So that's one critical component. Deals are still getting done, but the pendulum has swung pretty dramatically from being with founders to now being with investors. So investors, I think, now have a lot more power than they did last year or within the last 2 years to set different terms. So we're seeing different liquidity preferences creep into term sheets that weren't there last year or the year before. So 2x, 3x type liquidity preferences. So that's a pretty powerful sign of that things have changed. So there's been some dramatic shifts. I think the good news is that there is still capital out there, right? There are a lot of venture funds that have raised very large funds over the past couple of years and still have dry powder to deploy. Bioverge is a little bit unique in that we don't have a traditional institutional fund that we invest out of. We typically are investing on a deal-by-deal basis. But this year, we're on pace to close 15 deals in 2022. That's going to be our highest pace ever. So we're still heavily investing. Our LP base is largely individual credit investors or RIAs or family offices that invest with us. We've seen that maybe they've slowed down their pace of investment or aren't writing as large of checks, but they are still actively investing. So there is still capital out there. People are being more selective. VCs in general are making sure they have more capital in reserve to support existing portfolio companies, but there are still deals getting done.
Raj, so what are you seeing from a Bessemer perspective?
Yeah, echo some of the comments that Neil kind of just went through. I think in particular, absolutely for Bessemer, we have the funds, we have the mandate to deploy capital. And in fact, a lot of the funds kind of stipulate that we can only have so much cash on hand over periods of time. So it needs to get done, it needs to get allocated. But, as Neil said, there's definitely kind of this heightened level of scrutiny from an investor standpoint where we can take our time, evaluate businesses, and really kind of go after the best, if you will, because it is more difficult for founders to go out and raise capital right now. They need to be able to show kind of a business model that makes sense, that can get them to profitability in a reasonable amount of time. And so, there's less what I kind of term as swimming out in the middle of the deep end of the pool. They need to be close to the side of the pool where unit economics matter and profitability needs to be somewhere within their visibility. And so, with that said, good companies are going to get funded. They're going to get funded at lower multiples. That's just the environment that we're in. But if they've got a solid business that has large TAMs, we've talked about TAMs today, and unit economics that make sense, then they'll find funding. On the other hand, I think with companies that really are at the kind of pre-seed stage, there really needs to be a great vision that's painted. Founders that have been there, done that before, are certainly more in favor right now.
Yes.
I just speaking frankly, if it's the first time that you're doing it, if it's something that doesn't have any kind of business base at this point in terms of sales and, as I said, unit economics, it gets a lot more tougher in this environment.
You've been very frank with respect to, so yeah, what we are seeing out. So Bryce, how are you guys adapting to the changing landscape?
Yeah, so I'll just start with sort of a broad view. So healthcare is a great space to invest. It has been historically. Just looking into the public markets over a 5, 10, 15-year period, you would have been second in return relative to S&P to technology, and over a 20, 30-year period, third to technology and consumer discretionary. So out of the financial crisis, we've had extremely, extremely easy conditions, 0% interest rates or negative real interest rates. And that's provided that a lot of cheap capital, and in the private markets, a lot of tourist capital, being defined as a lot of hedge funds that are playing in the later stages of the private markets, trying to arbitrage prices over a short period of time. And a second factor of that would be funding the second, third, and fourth best of something. I think that as interest rates rise, and our central bank has never, the pace at which interest rates are rising are the fastest at which they have ever risen, and we have never risen them into a recession. So typically we have a place to start, and 0 wasn't a great place to start. You know, with the tools that the Fed have, obviously a lot of liquidity was pumped into the system, and now it's being taken out. So I don't think that the second or third of anything will be getting funded now. And I think that since public markets are down, the way that LPs will be allocating will start to change. It will be a lot harder to raise a venture fund that will be a 23 vintage, because you know, those books don't get marked down as quick as the public books. And so in terms of actual margin compression, throughout peak froth, healthcare was, the stock prices of healthcare companies increased because the way that people invested in them was as a multiple of growing free cash flow and growing earnings. These tech companies, it was a multiple of revenue and profitability way out into the future. So because of that, healthcare companies have been a lot more insulated, which is great relative to their tech counterparts. But I think that, like Raj alluded to, and Neil alluded to as well, it's a very capital. Some of these businesses are very capital intensive. So make sure you pick a partner that is with you till the end and willing to follow on and support.
So good. So the next question, once I ask the next question, I would like to get to the audience. The second question is more about the subsegments within the healthcare, right? So when I looked at the investment challenge last year, there were like a scripting, like companies that were focusing on, making the whole scripting thing, right? So there were a lot of investment. So now the telehealth, remote patient monitoring, all those kinds of things got a lot of funding last year. So with the changing environment in the landscape itself, the subsegments within the healthcare, are you seeing any changes, and which segments will get funded more in the landscape? If you could talk about the subsegments within the healthcare.
Yeah, so just briefly, I just want to build on what Raj and Bryce were saying, because I think it's really important. You know, with liquidity sort of being sucked out of the venture ecosystem, so to speak, right? There's been a lot of we call them generalists or tourist funds that have been into the venture ecosystem, crossover funds that have played in the private markets. You know, the Tiger Globals of the world, for example. You know, I think that created some bad behavior in the venture ecosystem, right? We saw a lot of deals where we were getting pressure to not even do diligence because the company had a term sheet, and they said, oh, well, we're going to close tomorrow. Do you want in or not? Like, well, it's not how we invest. Like, we actually have to do due diligence to make an investment. So that no longer exists, right? So now VCs are actually going through doing a more comprehensive diligence process than what had been done last year, for example, which net is a very good thing for the overall ecosystem. So I want to make that comment. In terms of the subsectors, it's a really good question. I mean, you heard my prior comment about, biopharma versus digital health. So digital health investment year over year is going to be down probably 50%. It's not going to be quite that dramatic in the biopharma market, but it's going to be down pretty significantly, maybe 25, 30%. So I think a lot of what we have seen in the digital health space in particular over the last couple of years, many of you have probably heard this term, but a lot of these technologies can be piloted to death, right? So you can go out, you can have multiple pilots with different companies, but the key is, well, how do you convert that pilot study to a long-term contract? Right, and so I think the ability for early stage companies in the digital health space is, how do you show what milestones you need to hit to go from a pilot study to an actual valuable contract, and ideally a multi-year contract. So I think companies that have a pathway to demonstrate that they understand what those milestones are between them and their partner, I think that's going to really help ease the mind of investors before making an investment. So I think that's one thing. We're clearly still seeing a lot of interest in some areas of biopharma. So, gene editing, for example, CRISPR-based therapeutics, diagnostics, right? A lot of that has come out of COVID as well. Everyone now is an armchair virologist, right? Everyone knows what mRNA is, for example, which is great, I think, for the overall ecosystem. So that has created a lot of momentum in the healthcare system in general. It also created a bubble in public markets, which is now popped, right? And so valuations have come down significantly in most public equities and healthcare in particular. And so if we go back to thinking about the crossover funds, those crossover funds are largely not investing in the private markets because they're getting better deals in the public markets, and they don't have any liquidity issues in the public markets. And so that will probably be the case for, I don't know, the next 12 to 16 months, I would imagine. So I think from a subsector perspective, digital health still an area of interest, not as much capital here as there was a year ago. Diligence is a significant factor, so the more traction you can demonstrate, the earlier you can demonstrate that traction, the better, right? So as Raj said, even a pre-seed or seed stage company, you're going to have to demonstrate much more traction than you would have a year or two ago. You probably can't just have a slide deck to get funded. You actually have to have some sort of tangible results. So I could probably talk for another 2 days, but I'll stop there.
Man, you burst the bubble. You said PowerPoint does not get funding anymore. So Raj, you have.
Let's see. So, I don't think we haven't kind of placed our chips in different areas at this point. Maybe that'll change. But right now, our roadmap is fairly similar in that we're looking at what we refer to internally as healthcare IT. So we're doing a lot of the administrative back office kinds of things. I mean, healthcare in general is still very messy. And so we're looking for companies that help streamline that and make it much more efficient. Healthcare is way too costly, it's unsustainable. And so we're looking at companies that are going to help solve those problems. And then there's tech-enabled type services that we look at as well. We're early investors in companies like Livongo. More recently, we're in companies like Hinge Health. And so these are companies that are trying to kind of make healthcare in general more efficient. And our chips are still on those bets.
Sure. Bryce, what other subsegments are you seeing sustain?
So I thought it was interesting for healthcare in 2022, there was more dollar amount invested in the earlier stages than there was in the later stages where rounds are typically bigger. So early stage investors are continuing to invest as they should, and like Neil said, with better terms and maybe better prices. And I just want to jump off onto a little bit of a side note. It's a thing I keep seeing everywhere, and I believe it's this false notion that there's this number, $290 billion of venture capital funds that were raised in 2021. Specifically, $60 billion attributed to healthcare-focused funds. and that when we all sort of agree that we're at the bottom and we're in a recession, that the funds will flow, the proverbial floodgates will open, and the private capital markets liquidity problems will all be solved. And you could put a enterprise value multiplier on that, because of course that's productive capital. But actually, I think this is the wrong way to look at it. And I don't think that there is $290 billion being waited to deploy, or 60 in healthcare. And the reason I think that is because when venture funds announce that they raise their funds, it's typically after they've already closed their fund. Now, it takes on average 12 to 18 months to raise a fund, and usually about 4 years to deploy it. So it's at least 25% deployed, but I mean, with the pace of investment in 2021, I think it's a lot more. So it's just a little bit of a side note, but it kind of goes into some certain trends that maybe should or should not have been invested in. I'll tell a little story. I see here wearables. There's a company that we invested in that is doing a consumer wearable, a non-invasive radio frequency glucose monitoring. I think a ring will be their first product. And they decided in 2021 that they didn't want to go through the traditional venture capital A, B, and C rounds. That would be, I don't know, too much of a strain. It would take away focus to just go straight to the public markets pre-products. And so they did that. And that's an example of something that you just wouldn't see today. And so I would say that, yeah, I mean, I'm not sure about the trend in certain specific segments, as it pertains to wearables or telehealth, but I think that the broad trend that everybody's talking about in healthcare is value-based care. And value-based care usually means, or as I understand it, has more to do with the preemptive action instead of just sort of charging a fee for service. And it would be in everybody's best interest, obviously, to make that as cheap as possible. So of course, the different approaches that different startups and companies will take will have different flavors themselves. But the way I look at it is, one interesting company that we invested in is called Apton Biosystems, and they're creating a next-gen sequencing platform here in Pleasanton. So the genome story, you probably have all heard that it's accelerating faster than Moore's law. And 20 years ago, it cost $100 million to sequence the genome, and now with Illumina, it's $1,000. So with Apton, we're trying to get that even cheaper. And the way that I think about it in relation to value-based care and preemptive measure is there's no better way to see how one is predispositioned to disease than actually reading their genome. So I think there will be a lot of interesting things that emerge from that.
Great. So now, any questions from the audience at this point?
Hi. I think what I'm hearing is that companies that are starting to generate some revenue and are a little more established are perceived as less risky and may stand a better chance in this environment. So we have companies on our platform, wearables, devices, new business models, and so on. So the question is, what can we do to help facilitate their initial growth, and how do we make them do better? We have close to tens of thousands of physicians on our network and over 1 million patients. So do you have specific advice on what we could do on our platform to help these startups get to a better place?
I mean, anything you can do to support traction, right? Whether it's uptake with the physicians in your network. So I think there's a number of ways to show traction, right? I mean, revenue is one obvious way, but that's not the only way, right? So maybe it's user growth, right? So it could be user growth with your physicians, for example. So month-over-month type user growth, that's one example. Strategic partnerships, right? Are there partnerships with other, corporate entities within our ecosystem where you can help them establish a partnership, for example? Maybe it's a pilot study. It'd be better if it were not a pilot study and it was something over longer term, but start where you have to. So I think things like that are really helpful. I mean, for the companies out there, right, obviously VC is just one type of way to fund your company, right? So non-dilutive capital is always great, and that's something that we always look for. Do you have an NIH grant, SBIR grant, grants from disease foundations or others, right? So as you're thinking about venture capital funding, right, make sure you don't forget about non-dilutive funding. You're applying for different grants. I mean, that's really critical. And I don't know if Charm can be helpful in that capacity, but I think there's a number of ways to help companies show traction beyond just purely on the revenue side.
Any other? There's one.
The garage had a
Go
comment.
ahead.
Finish that out. So, one thing I should note is, each VC firm has different focus areas, right? And as an example, with BVP, we've been primarily known as a Series A and beyond company. And so there's plenty of VC firms that are willing to do a lot of the kind of pre-revenue type of work, pre-seed kind of work. We're doing more of that. We did more of that as things became very competitive, but I think we'll go back to our roots in this time frame right now. But speaking of roots, to answer your question, I'll go back to my SaaS roots. I think if something that's been very helpful to grow SaaS companies, as you probably know, have been things like marketplaces. So if you can get visibility through marketplaces within Charm for your platform users, that may be interesting. In-product types of trials, that may be interesting as well. And good old-fashioned reselling type agreements are another way to give them visibility and potentially revenue for the overall platform.
All right. So go ahead.
My question is towards, is there a different kind of eyes when it comes to healthcare? The VC firms are looking at it versus the traditional social media or enterprise company. Before they say a word, funding is coming through. Why is all of a sudden when it comes to healthcare, the quote has always been Livando, Teladoc, this company, that company, and this is a generic question. I'm not. This has been there for a while. I just want to clear the air here. Is there a different? All of a sudden, when it comes to healthcare, the metrics changes compared to non-healthcare companies. Is that a fair statement?
Any of you can answer. Yeah, I think it's a really good question. I like that. What are the metrics in healthcare specific that you guys do?
I guess I can start. So first off, I think many of the firms, including Bessemer, has very kind of focused expertise in healthcare. And so as an example, we've got people within our team that we actually have MDs on the investing team. So they're very deep in this area, in healthcare specifically. I think there's also kind of, as I said at the top of the discussion, there are some parallels to other areas of software and technology, namely SaaS. And so we like to leverage those same metrics, things like MRR, ARR, unit economics, things like that. We like to leverage that where we can because we've got broad understanding of SaaS businesses. I think the areas like of scientific innovation and clinical work, that's a little bit more fuzzy, and that's where we bring in our deep experts in healthcare to make those kinds of calls, to evaluate how big and when these businesses may become a reality, because they're on, frankly, a different track than traditional software businesses.
So happy to add to that. So I think to your point, it depends on the sub-vertical within healthcare, right? So you can certainly apply SaaS metrics to a number of digital health companies, for example. So that's pretty clear. In biopharma, for example, right, there aren't those clear-cut metrics, right? So at the end of the day, if we take a step back from the 30,000-foot vantage point at Bioverge, what do we care about? We care about patient impact, right? We want to solve unmet medical needs. So if we're doing something that's benefiting the patient, that's our metric, right? How much of an impact are we going to have on a patient at the end of the day? If we can do that, we know we're creating value. And so that's our primary focus, and so that's really critical, and that's a metric that we sort of use as our North Star, and probably almost 60% of our portfolio of Bioverge is sort of platform biotech, biopharma type companies that are developing some sort of novel therapeutic. Probably got about 30% of the portfolio in digital health and digital therapeutics. Right, but even in the digital therapeutic space, right, where maybe you can measure, month-over-month user growth rates and things like that. Maybe it is more, SaaS-based metrics. We're still looking at how is that digital therapeutic or digital medicine going to impact the patient at the end of the day, right? How does it fit into the workflow of a provider? Is it going through a physician channel? Is it going straight to the consumer, right? What are those barriers? Is it pulling costs out of the healthcare system, right? As most of us probably know, the U.S. spends, $4.1 trillion annually on healthcare. 86% of those costs are spent on chronic diseases, which are largely preventable, right? And how do you prevent those? It's largely based on lifestyle choices, diet, exercise, things like that. The key question is, how do you develop some sort of software application that makes long-lasting and durable changes to behavior, which, as we know, is one of the hardest things to do, right? But if you can do that, you're having a dramatic impact on patient lives and health span and lifespan overall. So those are some of the things that we focus on.
So Bryce, a question for you. Though in the interest of time, 10 minutes, probably 2 more questions. So this is from a founder's perspective, right? So this came up yesterday. So at 2 questions. At what stage of the company do you want them to approach a VC for funding, right? So that's one. And then secondly, there is a general assumption that the VCs only come at a Series A or the seed or beyond kind of thing. So can they approach a VC in a pre-seed and that kind of stuff? So if you could address both of them.
Yeah, so for Tri-Valley Ventures, typically we're the first institutional capital in. We say early stage, which means different things to different people. We have invested in pre-seed, but mainly seed and Series A. For life science companies, they tend to be pre-revenue. So just kind of on the metrics question, enterprise SaaS can be very formulaic. What's the net dollar revenue retention, MR, AR, that sort of thing. But for the life science companies that we invest in, we don't really look at it from a multiplier of something perspective. We look at, well, one, the anti-market, and 2, how competent is the team. So for example, Amazon Biosystems, they have a very competent team. More than half of the company is PhDs. And what are you doing is truly differentiated. We're by no means experts in life science. We have a life science partner, but genomics, for example. So I guess to answer the metrics question, for the diagnostics, let's say for like a diagnostics company, with the razor and blade model, when there's not a lot of revenue, an early way we kind of figure out traction is, okay, well, first they're giving the device, and then they'll be selling the consumables or whatever it may be. So what research institutions are adopting these, or where's early adoption coming from? And in that way we can kind of try to forecast what revenue or appetite for different types of products might be. And sorry, I forgot your...
No, my question is from founder's perspective. I think you already addressed it, like at what stage you are doing that. If Raj or one of you want to address that question, yeah.
Yeah, I would say as a VC, we're not doing our job right if we're not in the market talking to every company that we can. I mean, within reason. We want to be talking to companies at every stage. We want to, that's how we get some of our education as well. And yeah, I think we want to be out there early and often and love talking to companies that are doing interesting things.
Yeah, on the same note, actually, one second. Like for example, what they have an idea. Is that the time to approach a VC, or you want them to make some progress before they approach the VC?
So as I was saying earlier, Ramesh, I think it comes down to also what is in scope for the particular VC.
Okay.
As I was saying, historically, BVP as an example, their sweet spot was Series A and beyond. And so, pre-revenue, very, very early companies were not as interesting. It got more competitive over the last 5 years or so, or a decade. And so we started to go, pre-Series A as well. We started to look at as well. To answer specifically the founder question, I think there's always somebody that's willing to listen. Whether they're willing to take a bet on you, it really it's based on your background, your experience, what you've done in the past, what kind of success you've had. They're trying to make a very kind of educated bet here on founders. So, just at the idea stage, there's somebody that would fund you if, a lot of those things line up for them.
Neil.
Yeah, I would echo what Raj said. I mean, I think there are sort of two ways to think about approaching VCs, right? One is obviously for funding, specifically when you have a round open, right? So if you're trying to raise a pre-seed round or a seed round, don't go to a Series A VC and expect your pitch to resonate, right? You've got to do your homework and figure out what stage the person you're talking to invests in, and that fund invests in. So that's critical. The other thing, though, that you can do is start building a relationship with VCs ahead of time, right? So let's say you have a seed round, so you get that seed round closed, right? Start building relationships with Series A investors before you start raising your Series A, right? So that's, I think, really critical, because a lot of this is relationship based, right? And so venture capitalists like to track a company over time, right? So if Raj is a Series A investor, they like to probably start to get to know companies at the seed stage, see how your team is executing. So when you get to the Series A point, they can see how you've executed over the last 6, 8, 12, 16 months. And so when you're ready to raise your Series A, they already know you, they've seen your track record, right? And we do a lot of that at Bioverge, right? So I think there's two components. There's actually raising your round, but then there's a relationship building component of it as well, which are both really important.
Excellent, thank you. So last question.
So, going back to the macroeconomic conditions that you covered early on in the discussion. So I heard, I think Raj and everyone talked about more enhanced due diligence, focus on unit economics and those sort of things. But my question, or I was wondering more, are you seeing any shift, not just in your funds, but just industry, around portfolio models, existing funds models shifting, given kind of the anticipation of the economic conditions, or new funds and how the portfolio construction is happening?
I think we might have said this already. Certainly, well, what I would say, the checks are getting smaller, at least on our end. Bryce may have mentioned the deal sizes in the past. In 2021 were particularly large, and it's been building over time. I think it's going the other way now. The valuations have been compressed dramatically. So those are two kind of fundamental changes that we've seen in investing. And I think the overall kind of level of diligence is definitely higher. No FTXs. Those are things I've seen.
The FTX is sort of like cautionary tale. It's sort of like probably the Madoff moment in the VC world. But specifically to your point in terms of fund model, right? VCs always have sort of fund model which dictate, asset allocation within that fund, and it changes during the life cycle of the fund. But I think we mentioned this earlier, but I think most funds today are reserving a larger amount of capital to support their existing portfolio companies. So whereas a fund may have modeled out a portfolio of 20 companies when they raised the fund, maybe now they're reserving more capital to support a portfolio of 15 companies, right? So they're not making as many new investments as they otherwise would have. So I think that's an important distinction.
Yeah, so it's interesting what Raj alluded to earlier. He said we're going back to our roots. And the question in itself is kind of interesting because it presupposes that all VCs may have been playing offsides or have gotten away from those roots.
Offside, huh?
And so, at least at Charmalot Ventures, the way that we're allocating capital and the sort of advice that we're giving to founders hasn't really changed. So we invest into 5 to 6 companies a year, and our check sizes haven't really changed. Our deal flow hasn't really changed. And I think that in some cases, some of our companies that had put an emphasis on efficiency at the cost of growth and actually had trouble raising capital in 2021 are actually finding that it's easier for them to raise capital in 2022. And I think that, I don't know if it's maybe the nature of the backgrounds of our partners, but we've always played kind of like a almost value, slow growth playbook where our focus is just to get them to the next round. And so what Neil said I thought was great. Yeah, there was companies that we invested in that we knew for 3 years that we didn't invest in until we decided, okay, now's the time. So starting to make those relationships with Bessemer now, so they can track you or Bioverge, they can track you when the time is right.